Welcome back to Getting Your Shit Together. Today, we are diving into a topic that affects so many of us: debt consolidation. If you're feeling overwhelmed by multiple loan payments, high interest rates, or just the sheer number of bills each month, debt consolidation could be a game changer for you. We'll talk about what consolidation really means, how it works, and when it might make sense as a financial strategy, and some other alternatives. Whether you're trying to streamline your finances or get out of debt faster, understanding these options are crucial. So let's dig into the ins and outs of managing your debt and see how it might help you take control of your financial journey.
Well, I think it's important to explain what debt consolidation is. But right now, I think it's a good idea to talk about why now. What's happening in the world? What's happening in Canada? Why is this a thing? And why are we choosing this as a topic?
For sure. I think even the federal government just came out with an announcement trying to give some relief.
So I'm laughing at some of the things that were included. Yay, you won't have to pay GST on your Christmas tree purchase this year. Woohoo! That's going to be so great for all those people that are also going down and cutting down our climate cleaners, right?
What got me thinking was why GST is excluded on diapers only for 2 months. Our baby is going away after that.
No, because they're trying to make some headway on what their polls are doing. That's really I can't see any other reason. This is simply for a poll exercise. They want to see if it's going to make any impact at all and swing things in their favor. Again,
so let's try to get the politics out of this and focus on the real thing.
Exactly. So why now, right? Why are we talking about this right now? You mentioned about, the government is trying to provide some additional stimulation and relief in some people's mind by taking the GST or some of the tax off of one spot and giving you money back in the other. The challenge is that I think over the last couple of years, the costs of everything have gone up at a pace that was much quicker than what your income went up by. So a couple of years ago, you could go to the grocery store with your $100 in your pocket, buy $40 worth of food, and that was enough for a weekend or whatever your scenario is. And you had $60 left over to do other things. Well, today, that number is you go to the grocery store with $100 in your pocket, you get the same things that you did a couple of years ago that now cost you $75 or $80, which means you have less money left over to be able to do whatever it is that you need to do. So
it's more like $60 less than what I want.
Exactly. So ultimately, in my mind, is seeing that people are stretched and stressed because they're using debt a little bit more in order to stay above or keep the balance of the $100 in their pocket, and they're putting things on credit because it's a pay later kind of thing. And it's created some challenges, and I think a lot of people are feeling it. Well, you and I have kind of looked at some of the government statistics that talk about debt and income and assets and all that kind of stuff. But when we look at what's happened since, take 1999 as an example, and I know that was 25 years ago, but the average person would have maybe about $126,000 in debt at that time, the average household.
Including all kinds of debt.
Including all kinds of debt, credit cards, lines of credit, mortgages, and non-mortgage debt like student loans, vehicle loans, et cetera, et cetera. And today that number is well over 400,000. So it's gone up fourfold. And I think, I feel like what's happened is we've probably seen a lot of that happen. It's not been a steady thing. It's been a little bit level and then a shooting up in the last couple of years. So people are struggling to deal with the rapid increase and slow following of the income going up behind it.
And income has not increased 4 times in the last 25 years, at least not the average income.
No. So our goal for today's meeting is to talk a little bit about one of the solutions that may be available for many of you, and that's debt consolidation. We just want to help people understand what is a debt consolidation, what ways can it happen, what are some of the things to think about, and is it right for you, right? Lastly, kind of making that decision after you've heard some of our information. What, in your words, Neil, what would you say a debt consolidation is?
As the word consolidation kind of implies, it's a process of looking at all your debts. And you may have, as we talked about before, right, may have different kinds of debt, like mortgage, a line of credit, couple of them, credit cards, loans, and etc. So instead of trying to deal with them separately, consolidation approach looks at, can we combine all of them into a single debt or a loan, which then the borrower can focus on paying it down, and maybe that consolidation process can save some dollars, which otherwise might not have been available because they are trying to make payments across a number of different debts.
Yeah. Each of those debts, whether it be an installment loan, whether it be a line of credit, whether it be a credit card, a student loan, or otherwise, each carry their own minimum monthly payment requirement. Some of them, with the minimum monthly payment requirements, may or may not actually pay down the amount of money that was borrowed.
Yeah.
Right? Sometimes it's just enough to cover the interest costs and the actual debt amount stays as is. And so
minimum amounts are just to let the lender know that you are still making those payments, rather than it's not doing anything to reduce the balance.
Exactly. And that carries on people because, as we mentioned, the cost of everything has gone up. And in some cases, I don't know, have you received a bill from any of your credit cards lately, Neil, that basically said that we're changing the interest rate and it went from 19 to 21% or whatever the number is?
I think for almost all the cards I have.
So our thought is to look at, exactly as you mentioned, is to take all of the debts that you have, or at least the ones that matter, and consolidate them into one payment, which would have an amount going to an interest cost, because that's unfortunately not going to go away, but then a bigger portion, hopefully, that's actually paying down the amount borrowed.
Exactly. It's sort of putting together a plan to pay down the debt instead of you just trying to hit 100 birds at once.
Exactly. And not relying on the hope of the lottery winnings this Friday. That'll take care of it all. Which, I'm not going to lie, I've seen an awful lot of people who talk about lottery winnings being the solver of all of their problems.
So then, is there just one way to approach this situation, or do we have multiple ways that you can look at managing or bringing debt under control?
This is probably, I think, the most important part of the segment today, which is that there isn't just one way to make this happen. There are multiple ways to consolidate debts, and we're going to talk about it. We're going to list a few of them, and then we're going to get into some pros and cons on what some of those are. But I'm going to list a few that I can think of.
Okay.
So one of the ways would be to transfer a high interest, high balance on a credit card to a low interest credit card. So you're effectively shifting the amount owing from one spot to another, but then the other spot is going to charge you less interest. And oftentimes I think that a lot of people who are keen on their own credit scenarios will do stuff like this.
Yeah, and some lenders or banks have offers where they offer a certain 6 month or 8 month period wherein there is no charge. But again, it's a short-term solution.
Exactly. It's one solution where you can take a couple of monthly debts and apply it over even to just one when you're in that situation. So that's one way. We call that balance transfer between credit cards.
Okay.
A second way could be maybe you go to the bank or somebody and you get a personal loan.
Mm-hmm.
I've seen, banks do consolidation loans. There are some other less savory places that do some consolidation loans. But they do happen and they can be effective as long as there are a plan in place.
Exactly. So loans come with a fixed repayment period and a payment amount. So it's like a mortgage trying to pay down the debt that you have. So it's more structured and working towards a goal rather than having balances on a line of credit, which may or may never decrease.
Yeah. And the other part that you made that you brought up was the fact that it's taking multiple payments and putting it into one, and that payment is going to be fixed for a period of time. So it allows you to adjust your budget accordingly.
Mm-hmm. Okay.
Is there another kind that you would think about?
Yes. Now, if somebody has a mortgage, then it does open up a few different strategies that they can look at. So if there is a standalone mortgage, and if they are maybe if makes sense, they could look at a refinance to consolidate all the mortgage or all kinds of debt together and make it one single payment and hopefully a lower interest rate.
Yep.
Some of the other features, if somebody has a house and a home equity line of credit, is that they could convert their higher interest debts by borrowing against the home equity line of credit. So thereby they reduce the amount of interest they are being charged. But of course, it needs to go beyond, and they need to have a plan in terms of how they pay it down.
Yes. A lot of people, we talked a little bit about, the average credit card out there tends to be somewhere between 19 and 23%. And there are a lot out there that are even higher. What would the average rate on a home equity line of credit be? And what's the difference between, credit cards and home equity lines of credit? Why is there a difference on the interest rate?
So there is a significant difference in the interest rates because, as you said, credit cards are high teens or above, maybe 20s, the interest rate. While a home equity line of credit, since it is secured by nature, secured by the property, comes at a lower cost. So you could get anywhere between, say, prime plus 0.5 or maybe even prime to a couple of points above prime.
So that's a really significant thing to think about when wondering, well, why is my interest rate on this line of credit tied to my house so much lower by more than half? Is it lower than what you're paying on a credit card? And this is the way lenders approach things. You have a house, you have that security, there is a more than high chance that that person is going to pay the monthly mortgage payment and the line of credit payment that goes along with it.
It's most likely the last payment that they would ever think about defaulting on.
Exactly. But phones first, right? And then credit cards, and then other financial service products. But houses are always going to be the last thing that they'll be late on or whatever.
And they'll give up on the private health insurance or dental plan before.
Exactly, right? And then there's one last thing, which is a method for doing the debt consolidation, and that is using a debt consolidation company.
Mm-hmm.
And you've heard about them, 1-800, debt blah blah or whatever. Trustees, they do a lot of radio advertisements and things like that. But we'll get into those a little bit. But let's get into some of the pros and cons overall of debt consolidations. Let's talk a little bit about why it's a good idea to do a debt consolidation. And we've touched on a couple of things, but you want to give me some just high level good reasons why we should do these?
Well, ideally, it should be lower interest cost.
Check.
That's a pro.
Yep.
Ideally, lower monthly payment.
Yep. Check.
Ideally, one single payment, or not many payments, but fewer number of payments.
And easy to manage. So check.
Yep.
Yeah.
Yeah, it's probably more emotional rather than financial. It's a
Yes.
peace of mind and sort of a feeling of progress.
Yeah. Reduces stress, right?
Yeah.
To me, that's a pretty important factor to think about, because a lot of people, when they act stressed or when they are stressed, you don't get the best out of yourself when you are stressed. So, reducing stress to help people live a little bit better, I think, is a good thing.
For sure.
And then lastly, I think that it can also help improve their credit score, because now instead of having 5 accounts with high balances across each, they've got hopefully 3, or maybe they've reduced their accounts, the number of credit cards, by canceling 1 or 2, but they should leave themselves with 1 or 2, and then they have this loan. It helps to make your overall credit profile look a little bit better, and it can probably increase your score.
Yeah, talking about canceling accounts, I would advise people leave their longest running
Yes.
accounts open and not cancel them.
Yes. Even if it is at a higher interest rate, if you don't have a balance on it, it doesn't cost you anything.
Mhm.
But having that longevity of credit account is good for your credit score.
So let's talk about the cons now. Are there any downsides?
No. Yeah, of course there are. Of course there could be. Could be. I'm not going to say are, like as if every time that it's the same. But there could be, depending on where you go to get the consolidation, there could be a fee for somebody to do that for you if things are bad.
Yeah, a mortgage refinance or getting a new mortgage, of course, comes with some cost. So
exactly. You may end up having, what in your head you might have thought, oh, I'll have this paid off in 7 to 10 years. In the case of maybe a car loan, when we're adding a car loan and a couple of other credit cards or something like that into a mortgage, now it's going to take you longer to pay off over time. So that is something to consider. Something that a lot of people don't often think about right away, because they're just looking for that end prize, is I want to get rid of these debts. And so when you consolidate them all into one, and it goes from being spread out all to over here, you now have access to those credit card and accounts again. And some people are like, I'll be good. I promise I'll be good. And then they're not. And then you end up with more debt.
They again go down those bad paths.
Exactly. Yeah. So what would be some good factors to consider before doing some kind of a consolidation?
I would like to add one more point. One is, especially if it is about consolidating and getting a mortgage. And if somebody is not able to still handle their debt good enough, they could easily run out of equity in their homes and put their home at risk.
Yes.
Right. So that's one downside to this strategy, because you converted your unsecured debts into secured debts, and if you're not able to manage that, then it puts you at a bit higher risk.
Yes. Yeah, that's a really good point. And I'm humbled, because I've actually seen that happen a couple of times since I've been an agent, where people they're in a bit of a situation and they say, I'll refinance. We go ahead and do that. We give them a plan for future. They don't follow it at all. And then they're back again in a year or two saying, life is what it is. And I made the mistake again. And here I am again. And property values haven't changed at the rate that their debt has increased. So yeah, it's definitely something to think about. What would you say is probably the number one thing to think about before you make any sort of a decision like this?
So there has to be some thought about the reasons behind why somebody is in a situation they are in.
How did you get here? Yeah.
Yeah. Where there are factors which are beyond their control, maybe like a job loss.
Or other ones. I don't
Yeah,
have a bar room here.
or is it just poor financial habits?
Yeah.
Right. So
Yeah.
unless they reflect on it and do something about the root cause of those factors, well, we can imagine there are things which happen in life which are out of our control, and we can't worry about them or we can't do much about them. But we obviously need to focus on things that we can influence.
I mean, anybody's goal would be to go from the higher credit card interest rate into a lower, secured kind of rate or something even lower. But there are times when, due to the previous financial behavior, that might not be possible. And you may have to look at some other avenues.
Yeah. And if they are at that dead end where there are no other options, then probably they have to take a hard call. And it could mean either a consumer proposal or a bankruptcy, just so that they can get out of the situation, make some improvements over a period of time. But they will have to go through hell before they reach there.
Yes. Yeah. Yeah. And then obviously, if you're at this point, it's worth looking at the total cost analysis to take, if you have $1,500 at 21% interest at a Canadian Tire card, and then you are thinking about rolling it into a loan that's going to take you 7 years to pay off at 9% interest, maybe don't do that. Maybe put some other ones over and leave the smaller debt in one spot and pay that off, with a focused approach. And then that way you're saving on some of the interest, because overall you've got to look at this total cost. I think that that's important too. Every person is like a mini business. And if you run it that way, then you'll start to see some of the rewards from being an active participant.
Yeah. And again, there are some alternatives to consolidation as well, right? Before you think about combining everything together,
Yep.
there are other approaches like a debt snowball or a debt avalanche, which could.
Yeah, and then another one could be that maybe you do a negotiation with a creditor, because they've probably made quite a bit off you. Some of them, when they learn that you're not in a very good position, and again, it could be because of job loss, it could be because the cost of everything went up so fast, and now you're just underwater and you need a break. Sometimes you can do a negotiation with a creditor. It might mean that you'll no longer have access to credit through that company, but it may stop the bleeding by saying, okay, here your balance is $7,500. We're not going to continue to charge interest on it. You're not going to have access to the account any longer, but we're going to create a steady repayment flow for you.
Every lender wants to collect
They do
the entire dollar, or at least a few pennies on the dollar.
Exactly. And it's a strategy that I've seen and used a couple of times, but I wouldn't necessarily say it's a first one to think about. It's definitely one in the toolbox of getting your shit together. And then the last, which would be in my mind a last resort, which would be the bankruptcy, which is you're basically throwing your hands up. And, I say it that way, but I know that that's not necessarily the case. A lot of times it happens when there is really no alternative. You just don't have the money to pay any of these people back. You've maybe tried the snowball, you've tried some of the other things, and they just haven't worked. If you're on a fixed income, and that could be because you have a job that pays you a certain amount, but the amount that you owe, just can't be met. You cannot meet your requirements based on the income that you have. And this might be a way to look at getting out of that situation. So the debt consolidation is combining multiple debts into one in order to try to make either the interest costs on the total amount of debt lower or to make the payment more palatable. And in some cases, removing it altogether by going through a bankruptcy or something like that. There are multiple methods to do this: personal loans, credit card transfer balances, and you can increase your mortgage or have your mortgage and add on a line of credit that'll allow you to combine all of your other debt into one, but again, as mentioned, at a lower interest rate. There are some pros and cons of doing all of these things, and it's always worth looking at. Some of the pros are simplifying your payments, keeping your interest or getting your interest costs down, and improving your credit score and hopefully a little bit of your lifestyle with a reduction of stress. As far as some of the cons go, you could come up with some or could have some upfront fees and costs when you're thinking of doing a refinance. If your situation is as such and we have to go to alternative lenders, it could be even higher costs to do that refinance. There is always the risk, if you're not closing the accounts that you're paying off, that you could just simply accumulate more debt after you've done some kind of a debt consolidation. And lastly, you're just taking much longer to pay off the debt as it is. Some things to consider: are you changing your behaviors, whatever it is that caught you there? If they are a factor, if you have a job loss, that's not something, that's not a behavior change that you can attribute to being negative. You've lost a job. So maybe the behavior will be that you'll find another job or you'll find another way of making income. So,
or save more money while you're working.
Exactly. Yeah. It really is to be a little bit more mindful of your spending habits. The overall cost of your debt, even though it's being pulled into something that's now maybe going to be a lower payment, the overall cost could go up because you are stretching it out over a little bit more time. And then some alternatives, which is, doing the work, right? Looking at some debt, snowball and or avalanche methods in order to pay that debt down a little bit more faster. But that requires a lot more personal input and sacrifice in some cases in order to make that happen. You could negotiate with your creditors to lower your payment, but that could have an impact on your overall credit as well. So that's something to work about or think about. Some credit counseling, there are options out there, and we do a form of credit counseling as well. When we help look at somebody's credit, we take all factors into consideration to help determine ways to be able to get you back onto the straight and narrow, so to speak. And then finally, bankruptcy are considerations to think about if you're at that point. And, whenever I'm looking at a file, and I'm sure Neil's the same, that is our last goal, to have somebody go through a bankruptcy, because it does impact them significantly for quite some time.
Especially if it involves a mortgage.
Yes. Yeah.
Right? So that has to be much more carefully thought about.
Yeah. And as we alluded to earlier, the statistics say that Canadians will pay their mortgage and leave other things behind. So that then creates a bit of a strange situation where, as you say, well, I have to pay my mortgage because I need a place to live. It's freaking cold, right? But then you leave the debt, and then eventually if you go and do a bankruptcy, the bankruptcy affects your mortgage. So it's just something that you really, really need to give much thought to, and not just one visit to a trustee. Promise me that you won't just go talk to a trustee and say, what are my options? Come and talk to us first. We'll try to give you some advice.
Yes. Yeah. Explore your options before you take anything drastic.
Yeah.
So I think that wraps up our deep dive into debt consolidation or debt management in general. I hope this episode has shed some light on the options available to you in general, the potential benefits, and to what to watch out for along the way. Remember, tackling debt is a marathon, not a sprint. But with the right tools, you can make a lot of progress towards financial freedom. As always, thank you for tuning in to Getting Your Shit Together. Don't forget to subscribe for more tips and strategies. And if you found this episode useful, consider sharing it with somebody who might benefit from hearing about debt management.
Yeah.
Until next time, keep focused, keep working towards your goals. Thank you.
Take care, everybody.